Hello, everybody. Welcome to the first live streamed YouTube chat of the Dinger Tokens Cativersity platform. You've got BMG with you here today, and we're going to be talking a little bit about technical analysis. I'm going to go ahead and give it a little bit of time for some people to pop in, get the link shared around a little bit, and then we'll get kicked off and started. Make sure that you jump in our Telegram at t.me/Dinger token. If you have any questions, put them in there, and I'm happy to get to them while we're on the live stream. But yeah, we'll get kicked off here in a moment, and excited to have this happen with you all today. Oh, looks like my audio wasn't going through. We don't have anybody in the stream yet, so we're going to get started once we get a couple people in. We are going to record this though, so looks like my audio wasn't going through. So we don't have anybody in the stream yet, so we're going to fill the chat up. I will go ahead and just talk for a little while, record it, and then we'll get this up. All right, it's about 2 minutes after the hour. I'm going to go ahead and give it another 2 or 3 minutes before I kick it off. Just give a few people some time to get in here. Like I said, I know it's a live video, so some people are going to want to probably be in the Telegram, giving some feedback, asking some questions. So I'll make sure that I give time for that. But we are also, like I said, going to be recording this as well. So if you miss out, it's okay. We're going to get it uploaded later onto the YouTube channel for everybody to watch in the back end. So getting ready to kick off here in a moment. Looks like we have 3 or 4 people in listening now. So we will get going from there. That probably would help. I made it accidentally private. So now it should be public for everybody to view. Let me grab a new share link. And pin. All right, updating. Just was changing the description there so that people would have some direct links to get into the Telegram if they join us from YouTube. But Like I said, it's about 5 minutes after the hour, so I'm going to go ahead and get things kicked off here. Looks like we have about 5 people listening in. Not too many, but we're going to record it, like I said, and we'll get this going. So today we're going to be talking about what is technical analysis, right? And one thing that I really want to harp on is technical analysis is a tool. It's some, well, I guess we should start with what is, right? So on Investopedia, as you can see on the screen here, technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity such as price movement, volume, etc. So when you're looking at technical analysis, you're really looking at a chart. You're trying to look at the candlesticks, determine trends, things like support or resistance, and make decisions based off of what you think the market might be doing next, right? Technical analysis, though, I say a lot of times, is technical analysis a meme, right? Because a lot of times it is. Most of these people that you're seeing posting their charts on Twitter, posting their charts in their Telegram groups on random altcoin projects that they're investing on, aren't really doing technical analysis in the sense that a professional on Wall Street might be doing. We have access to some tools at this level, but not an exceptional amount of data, not an exceptional amount of statistical modeling going into it. When you see an influencer draw a line, they're drawing a line based off of where they've seen the chart bounce many times. So see support, 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 resistance, 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 and they're making decisions based off of that. When somebody in the traditional markets uses technical analysis, they ingest all of this data and run this data through simulations. They run sensitivity analysis, Monte Carlo models. They do discounted cash flow valuations for traditional stocks. There's all different types of tools that traditional institutions are going to utilize to technically analyze the data and the chart that's being showcased to them. So that's when I'm saying it's a meme in the sense that most people are using it. Yes, there are people that can trade intraday really exceptionally well and make a lot of money just by looking at the chart. It's typically not the retail investor or retail trader, though. So that brings me to the next step. Why do we, as retail traders, want to use technical analysis still, right? It is something that can be a tool in your toolkit. If you're looking at the very, very long term of investing in, say, Ethereum, right? This is the ETH chart. And you see, the chart spent a lot of time right around this $2,500 mark. And you're a long-term investor and you bought a lot of Ethereum around this $2,500 to $3,200 mark. Maybe you want to buy some more, but you see it up at $3,400, right? That is telling you that, hey, we're approaching a resistance here. Maybe I could wait a little while before I do my dollar cost average. That's how I like to use it. I like to use technical analysis to help me with not necessarily timing the market, but if something looks like it's really, really ran hard recently, I might wait a couple of days before I do my normal dollar cost average instead of just allowing it to come out of my paycheck directly, which is also another good idea on the long-term time horizon. You may only be really getting a 1 to 3% differential, but the goal is to add those up over time. So then we can dive a little bit deeper into what is a chart telling us? What are some things on a chart that we're able to use to give us this information about timing entries, timing what we want to do with technical analysis, right? So I guess the first thing we need to understand is the candlestick. So all of these are candlesticks, right? Everybody looks at the charts. Sometimes people look at lines. Sometimes people look at candles. Typically, I feel like you're going to see a lot of people looking at candles. And basically why candles are important is because they can give you information about what was occurring during the market in the time that that candle took place. So let's learn about candlesticks, right? There are 4 components in each candlestick. There's the open price, the close price, the high price, and the low price. And what that's giving you is information about where the price of an asset, Ethereum, traded during a time frame. So right now I have the daily chart up, right? So we're looking at the daily time frame. Each one of these candlesticks is a full day of price action on the Ethereum chart. So remember, the bottom of it would be the open price. So the bottom of this candlestick is where Ethereum opened. The fat part of the candle, sorry. The wick is the lowest point that it reached. The top of the fat part of this green candle is where it's currently trading on the daily, and potentially if it closes up here, that will be where the fat part would stay. And then the wick on the top is the highest that it reached during that time frame. So what this candlestick is basically saying is that inside of the body is probably where most of the price action was occurring, right? It was opened here and it's closing here. So the wicks are the really volatile extremes of that candle. So when you're looking at a candle for potentially entries, if you're able to find a candle that looks like this, potentially, where it's way down, or it's opened here and it dumped, right? And you're looking at a huge fat red body, maybe that's a chance to get in. But again, just a tool, just something that can say, hey, this candle was opened here, wicked way down here because people were selling, and then it got bought all the way back up to here, leaving a long wick, right? Some people might say that seems bullish, right? Doesn't necessarily mean it has to go up. You can have candles with huge wicks, this direction right here, that aren't bullish, that are red candlesticks, right? We still had days of ranging here, whereas this one went right back up. So there's different things to remember when you're looking at candlesticks. And remember, they also flip as well. So the one that we were looking at on a green candle, when the price is going up, the open's going to be the bottom side and the close will be the top. On a red candle, if price is going down, the open will be the top part of the fat candle, the close will be the bottom part of the fat candle. So that's something interesting just to keep in mind. So now we've gone over just the generals of what is technical analysis, why is it a meme? You know, it's just a tool. We don't have access to all of the exceptional data that other people have access to. So it's mostly a meme. It's something that on majors, on macros, could be slightly beneficial for people to add it in to their decision-making process on when they want to make a buy, a sell, a whatever. Personally, I hate day trading. I hate doing intraday stuff. I really don't like doing technical analysis very often unless I'm trying to make a decision about something I want to do quickly. In that regard, what else is out there? You know, technical analysis. There's a ton of tools, right? They're all tools. I'm sure you've heard of people talk about indicators, right? So an indicator is another component of utilizing technical analysis. There are trends, there are patterns, there are things that can sometimes appear on a chart that when they appear, they are statistically more or less likely to be bullish or bearish. So you can add indicators to your charts to try to amplify your technical analysis. So what I have down here is what's known as the relative strength indicator, and I added a bullish and bearish divergence tool to it as well, and I'll get into that a little bit later. So what is the RSI, the relative strength index? I'm sure you've heard of people talk about it before. So the RSI is a momentum indicator, right? And it's used to measure the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. It's displayed as an oscillator going from 0 to 100. You can think about it like percentages. And it was originally developed by J. Wells Wilder Jr. Pretty cool. So what do we use RSI for, right? It was saying it can typically go from 0 to 100. So you see this purple range here, right? People have historically said that an RSI over 70 means that the chart is overbought. People have bought a ton lately. The momentum has been wildly bullish for maybe wildly too long. And it might be time for the chart to cool off a little bit when it's above that 70 mark. When it's below 30, that shows that the chart is oversold. People have been selling. The momentum has been downward for a long period of time. So if the RSI is below 30, potentially there could be an opportunity for an entry. Again, these are not tried and true, guaranteed bullish, guaranteed bearish. These are things to look at that can provide a little bit more insight to how the market is trending at that moment, not something to base your entire decision on. So RSI is something that's really nice to have on your charts just as a quick thing to check. Bullish and bearish divergences, right? So that's one of my favorite things to use the RSI for. So I'll show you an example here of a bearish divergence. So I'll explain what it is first and then explain why it's important. So when price is going up over 2 periods of time, sets a higher high at the same time as the RSI oscillator sets a lower high, that is what's known as a bearish divergence. And why is that a divergence, right? Divergence as in it diverges from the chart. The RSI momentum oscillator is diverging from what the chart was telling you. Price action might be bullish, higher high, but the momentum of the chart is skewing a little bit bearish. When it diverges like that, you might be seeing the market turn around for a period of time. And again, like I said, it is not guaranteed. It is never guaranteed. It's not 100% accurate. There are statistics that you can look up to it. These are things that you can add as tools. But so if the market price is going up, higher high, and the oscillator is going lower high, that's known as a bearish divergence. It's possible that the market could break down in the future. And you see, we had a short-term breakdown over that time right after the bearish divergence of about 30% on the ETH chart, right? It's pretty big. Then the market went way back up. This is a perfect example of the bearish divergence. Yeah, maybe it would have given you that 30% here, but what if you had sold, shorted, sold, shorted, sold, shorted all the way to here, and then the market started going up? Now you're underwater, right? So this is why they are used as tools and potentially not as the end-all be-all. The bearish divergence was correct. Right here, it bared up and dumped down 30%, but it was only for a couple of weeks, from the 7th of September through the 21st of September, and then the market started rebounding. Looking at a bullish divergence, it's the exact opposite. Here's probably a good one to show you. So actually, let's go to this one. So when price action is setting a lower low right here, right? So we broke down and then we broke down further, but the RSI is showcasing a higher low, right? See how the RSI was low here and then it went slightly up, while at the same time the price action was going slightly down. So what that's showcasing is that the market price action is bearish, but the oscillator is starting to trend more bullish, right? And again, it shows bull right here, and then we spend $139 days trending sideways and up to a 42% loss at the worst. So there's a couple of indicators that people rely on consistently that I'm showcasing here, and 2 of the 3 have already shown you that, yeah, maybe for a small period of time it trended bullish, but overall it was going back down. Maybe for a small period of time it trended bullish, right? Bulled up right here, and we went a little bit higher, right above the moving average, but then the market bared back down. So yeah, you can use these indicators, but you really need to make sure that you're taking all of this information with a grain of salt. You don't want to be leveraging yourself up, getting in positions where you can't afford to buy yourself out of the position just because there's some fancy indicator that popped up on a chart showcasing that you would be able to do that, right? So those are a couple of the indicators that I typically use. Another one that I really like is the Bollinger Bands, right? And so a Bollinger Band is a technical analysis tool defined by a set of trend lines plotted 2 standard deviations, one positively, one below, well, 2, away, from a simple moving average of the price, right? And you can adjust this within your preferences. So we'll go ahead and set Bollinger Bands as an indicator. And let's get out of that. Oh, it looks like it didn't show me them. Do we have a better one? Let me X out real quick. There we go. So Bollinger Bands, that's these blue bands, right? When a market is trending really, really hard, the bands get very, very wide and far apart. When the bands are really, really wide and far apart, I get a little bit nervous because the market has been trending and it might be looking for a reversal. When your band is, or when the price action is near the top of a band or the bottom of a band, you can use that as information to the fact that the market might be overpriced or underpriced at that instance, right? When it's breaking above the Bollinger Bands, it typically breaks towards the bottom of the bands again some points. But remember, the bands themselves are also moving. It's not an end-all, be-all. Sometimes it can break above like it did right here and then run even harder, you know? So it's something that you have to be very careful about. One thing that I like to use Bollinger Bands for is, like I was saying earlier, just something to help me with dollar cost averaging. If I know that I'm going to make a dollar cost average at some point in the next 2 weeks, but the market's up here right now at the top of the band, maybe I'll wait 2-3 days. Okay, now I can buy here. Yeah, it's in the middle of the band, but it's just a dollar cost average. I'm still getting to allocate consistently like I want to. Market goes up again. Cool, cool. Oh, it goes down. Maybe I can dollar cost average again because I see it broke below that band. The goal here that I'm really trying to harp on is that when you take a long-term focus, technical analysis, zoomed out technical analysis, looking at daily, weekly, monthly, yearly charts can be really, really helpful in getting a macro picture of, hey, maybe I shouldn't dump my life savings into Bitcoin right now. Or, hey, maybe I should, but also not that. Remember, making sure that you use this information to be rational, take your time, think critically about what's going on in the market, and make decisions based off of that. So that's just a general, quick, easy, background of technical analysis. I know it definitely wasn't very structured. I didn't write up anything to talk about today. I just planned on showing a couple of indicators, how people use them. There are thousands, You can look at all of these indicators. I encourage you to get on TradingView and scroll and look at them and see what works for you or what you think gives you good information. But make sure that you understand what you're using. Go look at how they calculate it. Find the formula. Understand it at a level of depth so that you know what this indicator is telling you about the market, so that they're not just buy, sell indicators, and now they are, oh, I'm going to calculate my risk. In my model for calculating my risk, I have a couple of indicators that I include to give me probability estimates that we are at a bullish point or a bearish point so that I can incorporate that into my risk model. So that's pretty much all that I have. If anybody has any questions, please feel free to drop them into the Telegram chat. I know there's about a 10-second delay on the audio coming through to you all, so I'll let it wait a couple of seconds and then here in the chat, if anybody posts anything, we'll go ahead and answer those questions. We can try to dive into something. Like I said, I would love for this to be a little bit Q&A oriented, but we have about 20 people in here right now, so we will, if anybody has any questions, go ahead and ask them, and if not, I'll give 2, 3, 4 minutes, and we'll go ahead and end it and post the video for anybody to watch afterwards. Thanks for tuning in, though. So, Winfried, are bands like a guideline on the average swings that the chart does? Um, Not really, you know. So, like I was saying, they are. Let me pull them back up really quickly for you. So, Bollinger Bands are just showcasing a standard deviation that you set. So, whoever built this specific script right here, and I can actually show you what they're, let's see, Pine Editor. Oh, they won't let me see it, will they? So I can't see how they set up their script, I guess, sadly. But yeah, so they're a standard deviation that you determine from the chart. So when you say, are they guidelines to the average swings that the chart does? They are, it's a good question. They are standard deviations from the moving average. So you see this red line right here? This is going to be the moving average of the chart, right? The moving price average. So this is not incorporating all of the wild swings, right? So when you have a Bollinger Band, it's showing you that there is one standard deviation to the moving average would be right about here. One standard deviation from the moving average would be right about here. You can determine in the script, whoever wrote it, if they wanted to do one standard deviation, if they wanted to do two standard deviations, if they wanted to do three standard deviations, however you want to do it. So you could say, yes, maybe it's a, quote, guideline on the average swings, but it's really not that. It's something that can tell you if something is in the middle of a wild swing or not. Right? If we're just hanging out around the moving average. So we're looking at a weekly chart right now. So in this period of time right here, right? The chart really wasn't trending. It was ranging because it was right in the middle of the Bollinger Bands. So there's not really much information to derive about the direction that the chart might be going from here. But right here, it had broken way to the outside, the upward outside of the Bollinger Bands, right? So that's saying, oh, we're at an extreme right now. We're at something that is a standard, at least a standard deviation away from where the price normally is. So something extreme might happen. So not quite average swings or guidelines on the average swings, but it can be something that can inform you if you are approaching or near an extreme. And it doesn't necessarily mean that it's guidance on that extreme stopping. This could keep going up. There's nothing that stops this chart from keeping going up and breaking the Bollinger Band. The band will continue to go up with it. See how when it goes, let's look at a little zoomed in one, I guess, from over here. So, right, see how it spent from November through February at or above the Bollinger Band, right? So that hit the extreme. Somebody could have been like, oh, look, we're going to dump now. Let's sell everything. And they would have gotten wrecked by selling everything. You know, the Bollinger Bands they change as the price changes as well because it's based off of this moving average. And it can give you some information on volatility as well, Winfried. So whenever there is a very wide spacing between the bands, that's showing you that the chart has been extremely volatile recently, right? Because the price has spread those bands out. When it's really thin, kind of like over here a little bit more, not quite that thin, but still more thin, like right in here versus, you know, how wide it gets right here. You see the difference between how wide the bands are here versus how wide they are here. When they're close together, you might be approaching a period of volatility because they've been the chart, the price action has been in a tight range for a period of time. When they start to spread out, you know that you have been in a period of high volatility for a long period of time because that volatility spread the bands out. So see how they're getting closer together right now? So what that's showing is that we just went through from pretty much January of 2021 through January of 2022, a period of extreme volatility where the bands were spreading the whole time. And now we're entering a bit more of a ranging period. You know, the bands are starting to come closer together. As they come closer together, we know that recently there hasn't been as much volatility by that. And that might mean that there could be some volatility on the horizon. Doesn't guarantee that there's volatility on the horizon. It's just another tool, another piece of information towards that. Sweet. So Tino's asked, how about adjusting the input scaling of data to the indicators? Could you elaborate a little bit about what you mean by that? Are you talking about like input as in the 20-week moving averages versus the 100-week moving averages as your inputs, or are you referring to scaling as in inputs like the weekly, daily, hourlies, the zooming out versus the zooming ins and whatnot? Sorry, T-Noves. I know you're the actual expert. Days of data indicator looks at it. Let me do that. I'll pull it up. No problem as well, Winfried. Did I type it in wrong? Or is it one of those premium ones that you fancy folk get? Days of data indicator. I don't know that one. Just in the settings. Oh, I see. Yeah, sorry. Oh, you might be talking about, let me go. And like I said as well, I really don't use technical analysis very much. I throw Bollinger Bands on my chart sometime. I have the RSI typically up, but I'm never really making decisions based off of it, you know? So I'm not spending too much time actually like writing my own strategies or writing my own script to build an algo that's going to tell me when to buy, when to sell, when to do all of these things. But people do that. People are really successful doing that as well. Let me see if I can update it. You said, oh yeah, sweet. So in here, we're looking at the settings for the inputs, right? So it's a formula like we were talking about. This is the formula for Bollinger Bands. You can decide the length. So this is going to be your, I believe your moving average that it's basing it off of. See how it's moving this chart. So what we're doing is we're changing from going, we started out at using the 20-week moving average as the center point that the bands are built off of. But what if we want to look at the 50-week moving average, the 60-week moving average, the 100-week moving average? We can do that, and the bands will adjust accordingly. Source close, so it's basically taking the closing price from each candle, and we're looking at 2 standard deviations. Remember, if I do 1, the bands get tighter. What if I do 3? They give you a little bit more leeway. So if you go to 3 standard deviations out, to break above this, you have to have a lot of volatility, right? That confidence interval is extremely, extremely wide. Not something that's going to be hit very often. So when it does hit, might be something to pay attention to. And I guess going 3 out also gives us a little bit better of a view on, see how it got really, really tight right before the period of huge volatility. And then it spread out, got really, really wide. And then it tightens back up. And then more volatility to get really wide. So we're back into that tightening up phase right now. So we might be entering volatility. And remember, it's volatility, It's not saying that we're entering bullish or bearish price action. It's just as these bands get closer, it's typically more likely for the price to move rapidly in one direction or the other, up or down, not necessarily up, not necessarily down. We're trading towards the bottom end of the bands, but still in this middle range. So yeah, that's a little bit of look at changing the settings of what you're going for. You can change styles too. You can make them pretty, do different things like that. But yeah, great question, Tinos. Appreciate you also walking me through that, getting me back to the settings. I'd forgotten about updating the inputs. But sweet. Let me see. Are there any other questions coming in here in the Telegram? It does not look like it, but we might have Winfried asking one, so I'll go ahead and wait for that. It has been in the chart that I'm showing us, which is only data from when they printed about 40% of all money in existence since. So if we look back, it might not always be that way, right? So let's go to some other cycles maybe to look at the chart. Let's get out of our little group think here with the nice fancy 2019 to 2021 market where everything was bullish, right? Well, I guess I'm not going to be able to do that. They get really tight early and then it busts. Well, I guess on the flip side, crypto has always been relatively bullish, quote unquote, if you would say, Winfried. You know, the fact that any and all of these assets have gone from pennies to thousands of dollars per unit. You are right that you're going to see a lot of that. I guess here's a good example of a breakdown, actually. Right here, right? So you see chart spreads wildly, and then it starts to enclose rapidly. And as we approach a period of potential new volatility, it dumps down, and that's how it's spreading it out. And then we enter our ranging period for a long time. Yes, Tinos, you are right. Every single indicator has different settings, different input settings that you're able to utilize. So I guess I can show, we can just go to throw the RSI one back up. Let's get a divergence one. No, I don't want that. I really should have pulled up the ones that I liked ahead of time, shouldn't I? We'll just do a regular RSI. We don't even need divergences. Sweet. So we've got our RSI up. What are those settings? So it's looking at the great bear market from before. Yeah, you're right. There's really never been a bear market. Well, quote unquote. Obviously, there's the bearish trends that have approached and been down for years at a time. But if you look at the overall return of crypto since inception, it would be pretty hard for me to call any of it a bear market. You know, anybody that bought more and had a time horizon of 5, 10, 15 years, you know, has made a lot of money. So looking at the RSI, the moving average type, simple moving average, exponential moving average, weighted moving average, volume weighted moving average. I don't know what this one is. I probably should know that though. Just so you know, those are just some different types of moving averages that you can use as inputs to calculate your RSI. Looking at standard deviations, etc., etc. Let me see. Let's look at a little closer time frame, maybe. Recently. So we can see that on the 4 hour, I love that, the great bear market from before. So on the 4 hour chart, we've got a big divergence here, right? Something simple to see. The price action has been going down, right? Let me grab some lines from here to here. Price down. While at the same time, the RSI has been establishing support. So momentum over the past, remember each one of these candles is 4 hours. So momentum since April 11th has been oscillating a little bit higher, even though price action has been oscillating down. Just something to look at, something to think about, something that's good to have as an important piece of information in your trading journey. Or investing journey, I guess is a better way to put it, because I would much, much rather have everybody look at all of this as investing and not as trading. You know, I am a big fan of the long time horizons, zoom out, really get into the what is the goal over a year, 5 years, 10 years. And if you look at from 2017 till today, it has gone up, up, up. Doesn't mean it'll necessarily keep going up, but the market has trended that direction in the crypto sphere. And I guess while we're doing this, one of my favorite things to talk about, I was saying earlier, the money printing, right? We can dive in a little bit to value, right? And liquidity. I'm going to do a deep dive on liquidity later, and I wasn't really planning on doing this today, but it'll be interesting just to chat with you all quickly. We'll take it off log. I'll probably go to log later. But so when you look at a chart, right? When we're looking at this Ethereum chart, we're looking at the price. One moment, I need to go close this door. We are looking at the price of Ethereum over, it's a formula, right? It is 1 Ethereum over 1 United States dollar, right? So the price for 1 Ethereum is $2,807, right? ETH over USD. The S&P 500, the price you are shown on your, wherever you buy equities or stocks or whatever, you're being shown the price of the S&P 500 over $1, right? It's priced in dollars. It's priced in $1. But we know that money supply is not stagnant. It's not static. It changes over time. So this chart right here that we're looking at, the blue line is the M3 money supply over time. Obviously, remember I was talking about since 2020 when they printed 40% of all dollars in existence. Right there. Pretty nice to see. But what's interesting is that it's not anything new that value and price have been diverging for a very, very long time. The value of an asset isn't necessarily its price. Its price can go up even if its value has not hit that point. So the green line is showing you what everybody sees when they see the S&P 500. They see the price of the S&P 500, which is priced over $1, right? That's the formula that showcases you price. Price equals value over $1, right? So that's the formula. The red line is showing you if instead of using $1 as your denominator, you use money supply, right? So what we can see is that in 1970 even to now, oh, I wish I could do the little measuring tool. From 1970 to now, we have only gone from about here to here. We at the COVID bottom even almost touched the value of the S&P 500 as it was in the 1970s. Since the 70s, since they've started printing money, the value of the S&P 500 trended down. Then we got our dot-com bonanza where everybody was trading like crazy, and it was a bubble for sure, a real bubble, but they hadn't gone too haywire with the money printing yet. So it was kind of okay, a little bit, not really. I mean, obviously the market totally collapsed, but it was able to be recovered by more money printing. And as you can see, since the 90s, we still have not reached the same value in the S&P 500 that the market saw in that mania phase. And it's due to the fact that they keep printing more money, raising the denominator, which forces the price up. Think about it this way. If the S&P 500, let's just say VOO, right? It's an easy stock to think about. The VOO is the S&P 500. It's the Vanguard version of the ETF for the S&P 500, right? So say it's $400. I know it's a little bit below that right now. If they print more money, right? The formula to get that $400 is price equals 400 divided by 1. Say they increase the money supply by 20%. So the denominator is now 1.2, right? That price doesn't change, or the price will change in relation to that 20% increase to the dollar supply, right? So it goes from 400 times 1.2. So now the price might show 480, but all you've done is take the price from 400 over $1 to 480 over $1, but you've printed 20% more dollars. So the value of the S&P 500, that ratio of 400 over 1, is the same at 480 over 1.2. So when they print all this money, right, and flood markets with all this money, they're showing the price has to go up because the denominator goes up. It forces the numerator up if the fraction is going to stay balanced. But the value really isn't changing that much. You know, we're just now breaking again above where the market was during the financial crisis in 2008. And so I'm not one of those people that's just mega bear, mega bull ever. You know, I'm young. I'm not quite as young as a lot of the people in the crypto space, but I'm not that old. I've got plenty of time. I have at least 25 to 30 years that I could still be consistently investing in the market. So my goal is to buy over that 25, 30, 40 year time frame, right? Everything. I want to buy anything because it's going to keep going up in price. But what's interesting to me about the market conditions, the market dynamics that we're approaching today, this 2008 area, right? Think about what has been created since 2008 in the global markets. Are cars more efficient? Do we have more technology? Can we travel more easily? Can ideas spread faster? Can people be more productive with less resources? Can more be created from less? Is the value that is created by humans in the overall market in 2022 greater than the value that was capable of being created by all humans in the 2007-2008 market? And I would argue yes. So when I look at this and I see they've done all this money printing, and I keep hearing about all this, the Great Reset, and all these people freaking out, and it's going to be the Great Recession, the markets are going to zero, blah, 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 blah. We might. It's very possible. We could easily go down. We could go way down. We might lose a ton of money. But when I look at this chart and I think about value and what's been created since 2007, 2008 in the world, I feel like there's a lot more value now than there was then, than there was in the 90s, than there was in the 70s. And they're going to keep printing this money. So if we as the retail investors all just sell all of our assets to the people who already own all of the assets, what happens next? Do they see, oh, okay, now it's time to put the value back into the market and pump the price to the point where no retail person could ever even afford to buy back into the market? I don't know. And I'm not trying to create FOMO either. Don't go dump your life savings into the market. None of this is financial advice. I'm not a financial advisor. I'm just some guy who understands a little bit about the markets, and I like to talk about my ideas of them and how I would think about them. But I am more scared of what happens when the value on top of all this money that's been printed gets put back into the market and myself not owning enough of the assets to participate in that growth. I'm not scared of the market going down for 5 years, 7 years, 10 years. We could downtrend for 7 to 10 years and I would be ecstatic because I would buy every asset at a discount over that 5, 7, 10-year period that I could, because I'm nervous of missing out on the value. And that's me personally. I have the ability to do that because I have a job. I have a full-time job. I also have a retirement account with my job that they are funding consistently, as well as myself funding it consistently. I have savings. I know that I'm going to be able to make rent every month. I know that I'm going to be able to pay for my food, to keep my pets alive, to enjoy my life. I do not put money in the markets that I need access to. I hope that I don't touch any of this money for the next 5, 7, 10 years. And so if I don't want to touch it for 5, 7, 10 years anyways, don't I almost a little bit want the market to go down so that I have the opportunity to buy more of the asset for less of the dollars that I work hard to earn? And I know it's a weird thing to think about, and it's a scary thing to think about, watching your money just disappear for a number of years. But if you believe that financial markets will still exist and that they will be an integral part to the growth of the global economy over the long term, then why wouldn't you want to participate in those markets over the long term? That's pretty much my spiel. Anybody have any other questions? You can drop them into the Telegram. I'm happy to answer them. I'll leave it open again for another 3, 5, maybe 7 minutes here, just to make sure that if anything else comes up, we can dive into it, enjoy it, talk about it. And it doesn't have to be about technical analysis either. I know this was a little bit more money supply value. It will come back up when I talk about liquidity, because it's very important when we talk about liquidity. But I'm happy to dive into anything else. I just thought that this was an interesting concept that's important for a lot of people to get some time to chew with and think about. Here's another one that, if you've never been on this page, this next one's going to terrify you. Over the duration of Bitcoin's history, the price of Bitcoin has practically perfectly tracked the growth of money supply. So when people say Bitcoin is money, this is what they're referring to. You're not getting rich when Bitcoin's price goes up. I can guarantee you that. You are not getting rich. All you're doing is not letting them play tricks with the money supply to make it look like your asset is going up in price when really it's just the same ratio at a lower value. Bitcoin is the only asset that has been able to consistently grow at pace with money supply. Winfried, I am not going to get into patterns. I'm not a technical analysis guy. I see the symmetrical triangles and descending wedges and blah, 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 blahs. What I would encourage you to do if you want to look into patterns, is look up a good book like, I don't know, we can just do Investopedia, look up candlestick patterns. And start understanding the statistics behind it. Don't just say, oh, this trend pops up, potential direction goes up. Learn. There are books out there. I can't remember the name of it. I've never read it. I probably should at some point. But there's a really good book out there that has every chart pattern and its statistical likelihood to break in either direction. That's the one time where I think patterns actually add value, because they're adding legitimate statistics. So you can say, so I'm going to put I don't know the statistics of this. This is me making up numbers. This is not information. It's made up, all of it, okay? So say they say a descending flag pattern, or whatever they call this, a flag pattern. When it breaks above, has a 60% chance of breaking to the upside and a 40% chance of, or a 20% chance of remaining neutral and a 20% chance of breaking to the downside. So when we get into later calculating risk, how you calculate risk is you basically create scenarios, right? So you say 60% chance the market goes up and I make X amount of dollars if the market goes up and I'm able to sell, right? You do the X amount of dollars times the probability of earning that amount of dollars. Now you have your flag pattern that's 20% likelihood to trend sideways. So now you have your middle case, which would be 0.2, 20%, times the amount of money that you would expect to win or lose there. And then you've got your third one. If it breaks down, your 20% times the amount of money you could lose. You incorporate all of those things together, and that's going to help you in calculating your potential, or your probable expected return, right? Once you know your expected return from those probabilities, you can calculate your risk, which helps you determine position sizing, et cetera, et cetera. But that's getting into stuff that's like day trading. Like I said, I understand it a little bit, but I'm not a day trader. I don't like to trade like that. I like to look at macro. I like, liquidity. I like value. I like really long-term oriented things. And I am going to talk about how we can calculate risk, and we're going to do that at some point. But I just want to encourage you all to not get caught up in that right now. And especially not necessarily with just me as the instructor. I'm going to have to read up a lot myself, and make sure that I'm giving good information when I do technical analysis, stuff like that, calculating risk and trying to make decisions based off of, oh, this is a pattern that has X statistical likelihood to break in a direction. But what I would encourage you to do is, find good books. Find a really good book somewhere that will tell you those percentages, and then start looking into it. But it looks like I've been online for about an hour. Oh, we got another question. Isn't it just like using the bands, but for predicting the future on the short term? Makes sense why it's used for day trading. It can be. I mean, it can be somewhat similar to the bands. The bands are more for just getting a general idea of historical volatility and if something is at an extreme or not. Whereas patterns are, I don't want to say a little more qualitative, because they are quantitative. You know, it is math still. There are people that run statistics and see how often typical patterns break to typical directions, but they're more, the patterns, let's look at it this way, right? So earlier I did the daily. I know one pattern that I hear people talk about all the time is this like triangle thing or whatever, you know? Say there's and I'm going to get these bands off of here too. So say This probably isn't a triangle, right? I don't, technical analysis gurus are going to hate this conversation and ruin me for everything I've said here today, but whatever. Um, it, I know what you're trying to say. It's a little like predicting the chart's emotions or sentiment. It is and it isn't. So Bollinger Bands are really good to tell you historic volatility and if you're at an extreme or something, right? Say this is I don't know, what, a descending triangle or something like that. I'm legitimately making up patterns. So this is not accurate information, and I apologize for not having the right pattern to explain to you. But say this chart or this pattern, when it appears, typically, let's say 60% of the time it breaks up, 30% of the time it breaks down, 10% of the time it remains neutral whenever it hits this end point over here or something like that. All that's giving you is what has historically happened from other people calculating on a chart. That has no relevance at all to what could happen in the future. If Michael Saylor tomorrow decides, I'm going to buy, say this typically breaks down 80% of the time, and tomorrow Michael Saylor decides he's going to buy $10 billion worth of Bitcoin, this was totally irrelevant, and it never mattered. You know, it's not important for that. So people can use it a lot when calculating risk if you're going to try to do intraday or more day tradey type stuff. But I really hate trying to use patterns or candlesticks in and of themselves to determine market sentiment, emotions, or trending directionality. Just because it's so, it's like playing roulette. You know, if you spin a roulette table and you get red 6 times in a row, you would think statistically your odds are higher of getting black on the next spin, but it's just not how statistics work. So when you look at these charts, they can give you a false sense of security if you're looking at like a specific pattern or something like that that's just only historic statistics versus bands or RSI or stuff like that. They're still total memes. Don't put your portfolio on it or think that that's the best decision ever. But that is more a formula that's calculating what's currently going on momentum-wise, price action-wise, and if you're at an extreme, whereas a pattern is just, oh, that pattern has this statistical likelihood. You know, yeah, I know quote unquote everyone is using it. I think everyone is using it because it's the easiest thing to do. You see how I just drew this pattern and I'm able to say stuff about it? It literally means nothing. What's better, in my opinion, if you're wanting to look for patterns or things like that, is just look more support and resistance. Don't try to get complicated with it, right? You can draw lines at where you think things look like they're happening and say, oh, remember we talked about candlesticks. There's some wicks here, right? Quite a bit of wicks. A lot of stuff got bought up. And it looks like it's also around a certain price, like right around that $2,500 mark, where there's consistently people there ready to step in, ready to buy, you know? But also, there's resistances on this chart. There's a resistance right up on the other side of this range. And when we reach that other side of the range, we're typically going down. Doesn't necessarily mean we're going to, doesn't mean we're going to keep going to, but supports and resistance to me is a little bit more, okay, are we at an extreme or are we somewhere in between, versus people just saying, oh, this random triangle has 30% likelihood, so I'm going to short it to the ground or whatever, blah, 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 blah. I like to use support resistance. It's a lot more consistent. It's a lot more easy for me to wrap my mind around. But yeah. So I would, and again, none of it's recommended. A lot of people make a lot of money trading patterns like this because they're good at it and they understand it better. There are tools all over the place. There are millions of tools that you can use for determining macro, determining price action, determining risk, determining your entry, when you want to get in, when you want to get out, different things of that nature. But that's all that they are is tools, and different people use those tools better than others. Like think of carpenters, metal workers, etc., electricians. Like an electrician's a lot better with wiring than a carpenter is, but I wouldn't want an electrician to build me a table, and that's kind of where that is. Good question though, Winfried. I liked it. Appreciate you guys checking in too. Yeah, support resistant. And again, like support and resistance is accurate until it's not, you know? Like let's find another one maybe. Um it's always so easy to find on the charts. I guess here's a good resistance, right? A decent resistance. Not great, not terrible, but we can see that for a period of time, we were hitting here and stopping even before we spiked up. Then we came back down, hit here and kind of got mad, hit here, kind of got mad, hit here, kind of got mad, stopped below, stopped there, but then it broke, you know? So like you said, it's good until there's Elon buying a company or big announcements or things like that. And another thing as well, technical analysis is a meme on small cap altcoins. It has literally no relevance. When total liquidity is somewhere around 100 to 200 ETH, and there are people running around with tens of thousands of ETH in a wallet, they could drop a negligible percent of their total ETH and completely change the chart. So when you look at technical analysis on like a small cap or an altcoin or something like that, you also have to take in the grain of salt of there are people out there that know that you're going to be looking at technical analysis, and their goal is going to be to trick you into making bad decisions so that they can make money off of you. And that's just probably how it's going to be. So I don't ever look at charts really on small caps. I look at fundamentals. I look at what are the team building, what are the goals, what are the objectives, how have they executed historically, how are they continuing to execute, different things of that nature. I'm really, I like to look at charts sometimes just to get a feel for it, but a chart on an altcoin or on a small cap it's a little bit of meme. The price will change when the market's ready for it to change, and it'll change in the direction that the market's ready to change it in. And that's just how that's going to be. Looks like we still have 3 people in here. I think it's just me, Winfried, maybe a couple others. But yeah, if you guys have any more questions, feel free to drop them in. I'm happy to dive in a little bit more. So yeah, you would assume technical analysis, TA, helps a ton if you are very well aware of what's happening on the overall market and how it affects the swings, especially recent news. Yes and no, for sure. So yes, right. We did this inflation chart. So people who saw Bitcoin dump in 2020, right here, as they printed 40% of the money in existence, right? They understood, as you said, the overall market. They were then able to take that information and utilize, quote unquote, technical analysis to every time that the price tanked below, say, 30 RSI, oh, we're oversold, time to buy. A bunch of people got really long here, made a bunch of money. Oh, we're oversold. I might, hedge a little, take some profits. Oh, RSI went back down again, time to buy. And a lot of people made a lot of money. Those people that you were seeing post, $100,000 plus longs on, even I saw a couple $1 million plus longs, etc. Quite a few actually during the bull market. Yeah, they were probably using technical analysis to recognize that there was an opportunity, a huge opportunity in the market. That was during macro craziness. The value had dumped an absurd, I think the S&P 500 dropped like 33% in 30 days or something. It was crazy. At the same time as all the money printing. So they knew something had to go somewhere. So then they just used their technical analysis to support their leveraged trading. I don't like to do that. I made a little bit of money leverage trading during the 2020 run up, but it's just so much stress, and it's so much ease, and there's a ton of taxes if you live somewhere where you get taxed on volume or on taxable events when you buy or sell. It can really cut into your profits a lot over the long term of it, and as long as you have resources to still be bringing in income without relying on income coming out from the market, it's pretty nice to think about it as from the perspective of my goal is to own meaningful percentages of these networks and assets instead of, oh, I'm just trying to lever up and catch myself a huge trade. But yeah, knowing macro is important because those people that knew macro after a huge bear market and then a giant COVID crash, knew that they could probably rely on technical analysis more for a period of time, but probably aren't relying on technical analysis a ton right now because the market isn't necessarily trending. Macro has substantially changed. The money printing has slowed down a little bit. And it's not being helicoptered down to individuals in retail that are net liquidity, removers typically, and not adders. They're not buffering liquidity. They're typically doing market orders, different things like that move prices and stuff. But yeah, no. So it is very helpful for some people if they understand the market and how these things are going to be influenced. But it's also, it has a time and a place that it's helpful. It's not always helpful. It might have been helpful during this whole run up, and right now it might be time to look more at fundamentals and to take a step back and not be looking entirely at the technicals of everything. Yeah, no problem, Winfried. It was great to have you here to ask some questions. I really appreciate the Q&A that you did. That you did have some questions. Otherwise, it would have just been me, sitting here talking into the void in an unstructured manner. So I think there's hopefully a few things of value. But I'm going to go ahead and end the stream here. It's been a little bit over an hour. So thanks again for everybody who joined us for our first one. And we'll be ideally doing this, like I said, once every 2 weeks. From now till going forward. And I do have a couple of videos that have already been recorded I'm waiting to get those out. They're completely edited. They're in John's inbox, and he's approved a couple of them, and we'll start posting them over time. But I do promise that I will start to hold these live streams relatively so that we can dive into these topics in a less formatted or structured manner, so that we can really get deep on what you want to know. And a lot of times, I'm not going to know the answers, and that's going to be okay. Like I admitted earlier, that there's a lot of stuff about intraday that I don't know or care to know. And so I'll try to point you to resources where you can learn about it yourself and self-teach. But thanks again, everyone. I'm going to go ahead and stop this now, and we will catch up next time.